Okay, so next up we have the Yield Generation Strategies panel, and it will be moderated by Diana Biggs. Diana, I think we could start with introductions, and the floor is yours.
Great, thanks. Welcome, everyone. Thanks for joining us for this conversation on yield generation. We have a fantastic panel, each representing the space from different angles. So if we could start by the panelists introducing themselves, a little bit about your background, and then your current role as well.
Yeah, thank you, Diana. Hi, guys. My name is Ilya Volkov. I'm CEO of Gaukler. So we are in the space since 2018. So we are CDFI platform, centralized, decentralized platform with number of services, including yielding, of course. So, and additionally, I'm a proud member of CVA, of course, and I'm a board member of the CVA. So, thank you.
Hi, everyone. I'm Oliver Yates, the CEO of Avho. So we're a French-based company who's been around since the end of 2019, and we're an EU licensed broker for institutional investors. So I've personally been working in this space since 2016, initially on the technical side, working on the Ethereum network, and then on the trading side, working on risk and trading signals during the big crash of 2018. And yeah, happy to be here.
Hi everyone, my name is Amor Sexton. I'm General Manager Ireland for Blockdaemon. We're one of the world's largest blockchain institutional infrastructure companies, so everything from node management to staking infrastructure. I have a background in legal, regulatory engagement, and operations. So I've worked at Coinbase as head of operations for the European crypto entities. I've worked in-house in Citi and BNP, looking at digital transformation and blockchain strategy, and then I was a lawyer in Australia for a time. So very much the boring end of crypto, I think.
Hello, everybody. My name is Michael Gaukler. I'm the head of product development at Bitcoin Swiss. We're a team between business and IT to push forward all our developments and therefore all the products and coming up with new products. From an educational background, I'm an engineer and an economist. Started out at the interface between technology and finance, and it's exciting times that these two topics come together so closely with blockchain technology.
Thank you, everyone. Now, yield generation has certainly been an enormous driver into the DeFi space over the past couple of years, as well as the source of some arguably healthy skepticism. If you could each touch on what type of interest you've been seeing in terms of yield and what customers you're serving in that space. Let's start with you, Michael.
Thank you. Well, let's define it first. I think yield includes as main categories staking and then returns from DeFi protocols. And we've seen huge interest in both areas. For the staking, we have a very good offering since several years now. We're working on a DeFi offering, and interest is huge, and opportunities are huge.
Great.
I agree. I definitely think the interest is increasing. I think from an infrastructure perspective, our focus is on how do we provide the infrastructure in a way that allows our clients and their yield generation activities to really scale. And I think it's early days yet, and although the activity might seem big, where it can go is exponentially larger than where it is now. And so how do we make sure that as the kind of infrastructure backbone of the industry, how do we make sure that we then scale our operations and our technologies to be able to handle not just enterprise grade, but I guess the next level, Terra grade, once we start seeing the type of activity that I think there's potential for.
Can we just dig in a bit more in terms of from the perspective of an infrastructure provider, where does that yield generate from, or what are the offerings in terms of that?
So I think for us, it's about, again, it's staking and DeFi, and how do we support people doing that, whether it's providing the staking infrastructure, so you can white label our validators if you want to do staking, you can utilize our nodes in many other different ways. But I think as we look at what's coming down the line from our product suite, some things I can talk about, some things I can't talk about, I think we're really looking at access and multi-protocol access too. So again, we heard when we were talking about the metaverse and NFTs, about interoperability. the idea of being able to, in a game, not be in a closed ecosystem, but being able to move between games. I think it's the same when we look at yield generation and DeFi, and how do you create the easiest possible access for people to be able to participate, and then participate across all of the different projects that are starting to develop in the market.
Great. Oliver?
So for the second question, I mean, the first one about interest, in our case, we've seen a lot of discretionary hedge funds, some hybrid VC firms as well, and family offices. So these ones have specific interest in generating yield because they'll typically hold their coins for a longer period of time, and they kind of know when they'll be rebalancing their portfolios. So it really, it's a good mechanism. If you're keeping your coins, you might as well add that, that layer of hedging. In terms of infrastructure, in our case, we're really just, we sit at the top of a bunch of different protocols and centralized lending firms. And I'd say what makes us special here is that we will lend internally to hedge funds and other trading firms that need leverage or shorting capability, which means that coins that you would not necessarily get a lot of yield on through staking or DeFi, you're still able to generate yield through us because we're lending it internally, keeping it in the loop. And then, of course, the rest will dispatch it to staking providers or other lending firms that will absorb the excess liquidity.
So in terms of structures, I just like to state that I hope that for everyone it's clear that there is no magic stick in the world, right? There is no magic stick in general. There is no magic stick on the financial market, and DeFi is not a magic stick, unfortunately. So, and in terms of structures, so there are not so many ways to generate yield, right? So first of all, it's a traditional, we already can say traditional staking when you stake on the node. So second, providing of liquidity and getting piece of commissions from liquidity usage. Then we can speak about lending and borrowing, so getting commissions out of it. So and then it's some kind of a parallel to cashback systems when someone can generate revenue inside the system and share the part of the revenue to its members, right? So, and when we speak about define different strategies and different methodologies, we should be very careful with classifications. So about what kind of yield we're speaking, right? So in our particular case, so we mostly work with CDFI model, where we generate revenue in-house and we pay back part of this revenue to our users. So, and we are pretty much confident that this is a stable system. So, and as for bridges between CFI, DeFi, and technologies, I think, we already see a lot of ways of collaborations between centralized platforms, systems like we are or Bitcoin Swiss, and DeFi protocols, and yeah.
Great. So, Michael?
Yeah, that's an interesting explanation and quite different to how Bitcoin Swiss works. We give the clients access to these protocols, but they know pretty much where they want to go. So we don't mix it up, but make it easy and secure to access.
And so when you have these clients that are considering the various potential avenues for yield generation that they can go down, what are the considerations that they should bear in mind?
Well, we have knowledgeable clients, and many of the early adopters became like whales and now funds. And one important aspect is the regulatory framework. So we're committed to Switzerland. We want to provide access to regulated and trustworthy participants in the system. So the regulatory part is difficult to figure out. And then I think we share the same issues with the whole risk management and the operational parts, how to get in and out safely, monitor the protocols, react quickly enough in case something goes shaky.
Yeah, and the sustainability of these yields has been obviously a consideration. We know from institutional investors that sometimes these high rates can be a deterrent more than a detractor. How are you viewing the sustainability of yields and how you manage that within your respective platforms?
It's not sustainable yet. So I'm really pretty much pragmatic on it. So, and I'm a big fan of strategies like barbell strategy. You know, where you should barbell strategy, like where you should invest like majority of your funds, like 80%, for example, with highly liquid, stable, low-risk assets, and you should play with the rest 20 with risky instruments and. basically the word play describes this very well. So when we speak about yielding on DeFi, of course, it's a high-risk strategy if we exclude traditional staking. So all the rest, of course, strongly connected to the stability of protocols, but we are still on the early years of the industry, right? So that's why it's not really stable, but it gives a good chance to play and win. But again, if we follow this pragmatic principle, 80 to 20, or for someone it could be 70 to 30. So again, my point is that we are still at early stage of the development of this industry. So it has a huge, huge potential, but we should be very, very careful with it. And we recently got this nice example with Terra and Luna, right? The good lesson is that now we see how it could be. The good outcome is that the industry in general demonstrated a high resilience, right? So we survived. So, but it was a good lesson that people who just played with that with some small amounts of funds survived and got a lesson. People who invested like 100% of their portfolios, so they are extremely disappointed. So, and that's why my point is that we should be very careful, but at the same time, we should push this industry forward. We should invest in those protocols. We should build bridges between traditional and modern finance. We should build bridges between CeFi and DeFi, so on and so on.
I'd add something here, which is, I think that what's not sustainable is the state of mind in which market participants are regarding yield. You know, if we dig a bit deeper, you have 4 ways of generating yield in crypto. The first one would be actually investing in some form of a venture and getting returns from that, which is what most people do not do. It's not the most common way to do it. It could be, I don't know, renting out your Axie Infinity character, for example. The second way is premiums from a loan, whether it's DeFi, CeFi, doesn't matter, but that's how it's economically generated. The third one is actual price appreciation from the asset you own. And the fourth one is a gift or a subsidy by a protocol. And so if you look at what most people are doing right now, for example, if you look at what happened with Luna and Terra, half of the yield was a gift and a subsidy. The other half was an actual premium from a loan, and that part is sustainable on the short term. The other one is not, economically. If you look at staking, ultimately, it is ad hoc creation. It's, most staking protocols, at least, it's around an inflationary mechanism, which means that on the long term, when you're getting that 6%, what you're actually hoping for is that the actual underlying asset will gain value, because then the question is, if you're not doing that 6%, you're actually losing value on your portfolio. It's more of a sunken cost. And so I think it's important to dot the I's around that and keep in mind, as you said at the beginning, there's no magic stick. It's not magic, it's just a way to make things a bit more liquid and maybe hedge on the short term, but you're never going to make like 40 or 20 or even 10% in dollar value in like a year or 2 years by just holding assets without taking too much risk, at least.
Yes, it's interesting you bring up the staking again. I think staking is a bit different to these others, because staking, you're part of the infrastructure of the network. And you ended the inflationary. It would be quite easy if it's just the transaction fees that bring in the returns, and then the returns would shrink as more money comes into the system. But because it has this inflationary element, you're actually getting future promises, future utility that's distributed already now through this inflation mechanism, and that somewhat makes it scalable for bigger capital to come in and see this future potential and get some of the reward now. So I think staking per se is sustainable, but still it needs the adoption. The blockchains must provide real value, utility, where at the end of the day somebody pays transaction fees or gets onto the system and participates. And I think we're in the 1990s of the internet, if you compare it. So we see the utility of the internet, and if you could back then have gotten a piece out of the future utility, certainly would have been a good investment. I think the DeFi protocols, they're a bit different. There's a lot of liquidity providing and lots of things that go well when the market goes up. People want to leverage and need to take a loan to do a leverage trade, and they're willing to pay for it as long as things go up. But it's all within this enclosed ecosystem of crypto, and as long as it's all happening in there, it works, and as long as crypto goes up, it works. But things are much more difficult when markets go down and no one wants to borrow or leverage. So I think they're good, solid concepts, but much more fluctuating. And then, of course, I fully agree, all these subsidies or the protocol tokens, they're not sustainable. There's just a fight for liquidity, attention, whatever.
Great. Now, we're seeing a lot of more traditional finance players that are moving into the space, and obviously, given this is a new technology, new paradigms, we also need to look at new systems and methodologies for risk management. What are you seeing in terms of risk management, or what would be the new considerations that investors would have to bear in mind when turning to this space for yield?
Great question, and actually that reminds me, a few weeks ago we attended the Paris Blockchain Week Summit in Paris, obviously. So, and there were a lot of discussions about yield, about DeFi, and there were some number of traditional institutions presented. And upon question, how do you generate revenue, how do you generate yield for your treasury, many of traditional institutions mentioned Anchor protocol. They said that it's so nice, it's so easy. We are being a traditional institution, can easily allocate some part of our treasuries for Anchor and simply get a return. That's so nice, that we love DeFi. So in a few weeks after, of course, they said, okay. So, but that brings me again to the same point about like 80 to 20 or 70 to 30. So in order to properly manage your treasuries, to properly manage your risks, you always should be conservative with the majority of your funds. And at the same time, you should play with the rest. And you should maybe at some point like bet on something, because out of it, you can get, first of all, you can get a good return, taking a risk, but on the other side, you also can help pushing the industry forward. You can help with the development of different protocols. You can drive innovation by taking this risk. So except this example with traditional institutions invested in Anchor, I think we still have great potential for both sides, for traditional finance and for modern finance. And we already have a lot of great examples from both worlds who are allocating more and more funds to drive this industry forward. But again, the key principle for risk management is just to properly distribute your funds between different instruments, different kind of assets, different kind of protocols, if you speak about DeFi. So we follow this principle.
I mean, I can list a few questions that we've been getting from our customers, concrete examples here. Typically, okay, so if you look at how Apple generates yield, part of it is internal, as I mentioned before. Part of it is lending out to other vetted desks, and another part could be permission DeFi pools or staking. And so the questions that will go around here is, on the internal lending, typically, I don't know, what's the leverage that you give to customers? That's something that they have to evaluate. Another type of question that we often get is, all right, if you're lending to external players, are these external players prop shops that will trade on a proprietary basis to generate that yield? Are they pure lending desks? In that case, is it over-collateralized, under-collateralized? If you look at permission DeFi, to be honest, at that stage, they're still trying to figure out the questions. And then on the staking side, there's a few really important topics. Like, for example, what happens if slashing occurs? Who takes on the loss? You know, those are the types of questions that they look at, because at the end of the day, they want to face one entity, or at least a minimal amount of entities, and make sure that someone is liable if something goes wrong.
Yeah, and more, I imagine, as an infrastructure provider, these are the new types of risks and considerations that you're having to explain to people.
Yeah, absolutely. I think as an infrastructure provider, if you're trying to choose an infrastructure provider, for example, for staking, you want to look at three things. You want to look at resilience, so you want to make sure that they're not just their technology, but actually their operational processes are resilient enough for what your needs are, and that they can support your business. You want to look at governance as well, whether it's governance of how their operational process for how they govern their participation with the protocol, the level of interaction that they have with the ecosystem, how well do they know the protocol, how involved are they with the development of it, and then how well are they managing governance of their activities in relation to the protocol as well. And then obviously insurance. I think we were the first staking company to offer insurance, and I think it's becoming a lot more common, but making sure that you're aware of what that insurance policy is, what does it cover, what is your potential exposure, and like you said, what happens if something goes wrong. I think that's, and from if you're looking for a validator, if you're looking for someone to help you with your staking, they're the things that you need to look at.
Might be worth for the audience if we can just break down what we mean by slashing insurance.
So slashing insurance is essentially, it's an insurance policy where if an event happens where a slashing event happens, so if you're, it depends on the different protocol, but basically if your amount that you've staked is penalized because of a slashing event, an insurance policy will cover your loss. It's similar to the way other insurance policies work. Not everyone will have the same insurance policy, not everyone will have the same coverage, so it's important to do your due diligence and just make sure that it's fit for purpose for your activities.
Back to the risk management of this was the question. So at Bitcoin Swiss, we look at 4 different types of risks. The first 3 we have to monitor. That's the technical risk. Is this technology sound? Is the smart contract audited? Does it have a track record, be it in total value locked or just existence and size? Then the economical risk. Is this feasible and viable at all? If all the participants act rationally, is it stable? And then there's also the centralization. Is there any party controlling this protocol or having a lot of influence on the network? Or is the governance centralized? Or is there an oracle that's centralized that somebody can influence? So being decentralized is really, really important. And all these 3 things, they are not something we can directly influence, so we have to monitor it carefully and be ready to take action if something goes shaky or becomes unstable or needs our attention. And then the 4th one, similar to the others, is the operational risk, where we just can do everything professionally feasible to mitigate risks, have proper processes, have documentation, have 4I principle, all the things that the classical world, to be fair, is actually quite good at.
I think as well, this isn't my space, so I won't go into it in too much detail, but I think you mentioned earlier about more and more institutional players like banks, and I think whether it's actually the banks themselves or people from the traditional finance world that are entering, they're bringing in this wealth of knowledge that it's not just about yield generation and risk mitigation, but hedging your risk as well and making sure that your risk mitigation policy includes everything from looking at operational risk to making sure that you've got that real kind of proper portfolio view across it. And I think that's where we're going to start to see, there's so much focus just on the generation of yield at the moment. We're going to start to see some really interesting new products come out on the market where people are starting to be a little bit more creative about how they're mitigating their risk as well and managing their exposure.
Thank you. So we are unarguably entering a bear market now, and as we mentioned before, with some of these protocols, obviously there's different considerations to bear in mind when things aren't going up only. Given the current macroeconomic conditions, rate changes outside of crypto, within crypto, those conditions as well, what does that mean for yield generation?
I mean, well, we mentioned it before, but the subsidy and gift part is not going to last long, to be totally honest. Like, even if you look at even the different big exchanges or brokers that used to offer credit cards with huge cashbacks, they all downplayed that. I mean, it's free money. You can't keep that on for long. What's interesting, I think, is to look at lending rates. Like, why do you get 6 or 7% per year on dollar, essentially, when other people get 0.3? And actually, there's a few explanations. I mean, that's my opinion, but there's a few decent explanations for that. The first one, which is fairly simple, is that if you're a crypto player, it's difficult to borrow dollar, but someone's going to lend you USDT or USDC. And so you're ready to pay a premium for the right to use dollar equivalent on the crypto network. The second one is that a lot of people need to settle fast and in instant fashion, and you can't do that with dollar unless you're part of the same bank or the same network. Now, the other reason for that is, that's the one that's actually going to go down, in my opinion. You had so many of these DeFi protocols that offered insane in-coin rewards for using their protocols. And at some point in that chain, people were then exiting these positions and selling them on the markets. And so there was a very high drive for stablecoin flow. And if we suppose that all the subsidies are going to go down, there's probably going to be a bit less of that, and so a bit less demand on that side for stablecoins. So I don't think it's going to go down to whatever you get on real dollars, but the insane yield you get right now on USDT, I don't think they'll last really long if we look at it that way. But this is not investment advice, by the way.
None of this is. Any other views?
Yeah, of course, we're again entering into another recession, obviously. So, of course, interest rates will go down. But comparing to traditional finance, I think we will still get some positive rates on the crypto market, but we should not expect some high returns. We should not expect 100% annual, and even like 12% annual maybe will be like a top level for return for the next I don't know, few months, maybe a year, maybe two. So, but in general, crypto and all these innovative products and protocols definitely will help us to not just to survive, but maybe to find some solutions to survive during this kind of period of times. So money was created to make money, right? It was not fair that traditional finance started to provide us with negative interest rates. And crypto here is to solve this problem. And even during the time of recession, I think we can find a way to generate positive returns. Why? Because we have something new, and we have new technology, we have new solutions, we have a lot of new and smart people who are trying to solve these issues. So maybe it's too much philosophical, but my only point is that I'm pretty much positive about crypto during this time of recession. Yeah.
Yes, I agree. So about the yields and the bear market, I think that this borrowing and lending is very much contained within the crypto space. So the dollars that somebody takes out, they don't go out and to buy, or rarely go out to buy cars and things. It's disconnected, and that's also because you can't take collateral from the real world and post it inside the crypto world. So bear market means...
For now.
Yes, exactly, for now. And bear market means interest rates will go down on these borrowing lending protocols, and it's a great time to biddle, as I say, with a great mindset. I believe in the future of crypto, and I believe things will go up again, and then these protocols will go crazy again. So we're getting ready to provide and create these products that are needed to get into the next bull market easily.
Yeah, I think that if I kind of take a step back and look at it more philosophically, I actually think it's a really exciting time. Because when trading there was so much focus on trading, and there was so much opportunity there. I think what happened was maybe innovation was a bit slower in the crypto space because there was so much focus on what was provided that kind of instant return. And I think what we'll see is that people are going to take a bit of a step back and go, okay, well, what else can we do? We're going to see more product innovation, whether it's in hedging risk, whether it's looking at new ways of generating yield, or just generally taking a bit of a deep breath and being able to look at all of the opportunities that the technology will provide, and reducing a little bit of the focus that just on the kind of trading side of crypto. And then I also think that the focus on governance is a good thing. If the industry wants to get where we think it will get, if we really want to start operating at scale, then I think some of the recent events have taught us the importance of making sure that we treat our crypto projects the same way we would treat any other business, that we do due diligence, that we have resilient operational structures, that we really think about these things. So I mean, is it going to be an easy ride? I don't think so, but I do think that what we will see come out of it is perhaps more robust projects and more product innovation in the crypto space as well.
And when we're looking at that product innovation and looking out into the future and bearing in mind that this is most likely the time for building great things, let's think about the predictions that we have and what we would like to see emerge in terms of new types of offerings and what would be possible, say, 2 to 5 years out, being the crypto time span for 5 to 15 years in any other industry. What are your predictions going forward, or what are you most excited about or working on for the future?
Okay, so if I may, I'd like to use Hodler, my company, as an example. So we started by building bridges. So firstly, we have built bridges between crypto and fiat. So on our platform, you can easily use both crypto and fiat. So now we are focused on building bridges between CeFi and DeFi by integrating different protocols, different kind of DeFi instruments into a centralized platform. And the key idea here is quite straightforward. So we'd like to make an access to DeFi really convenient, really easy for just normal people, like for just normal people, not crypto geeks, not crypto nerds. So my prediction is that we will have a lot of really easy to use solutions pretty much soon. So, and during the next few years, it will be quite common to open your application and use your crypto the same way like fiat, and use your DeFi, different kind of DeFi products the same way like you use traditional financial products. Many of us use applications like Revolut or N26. It's quite common and it's quite easy. So we'll be using all these crypto features, DeFi features the same way. So here's my prediction, if I may. So, and we are working on this already, and many of you, I believe, working on this as well. So, and in general, so again, I'm pretty much positive. So we are working at exciting time with exciting features, and yeah, so.
I'd have two kind of predictions in a sense. One of them around the landscape and regulation, and the other one more around usability. So if we look, 5 years forward, what you have right now is a race between the EU and the US, very slow race, to set a common regulatory standard. It's a very, very slow race. And at this stage, it's hard to say who will have a common and robust framework first. And based on that, this is going to determine, if the EU stands a chance in terms of innovation and innovative DeFi protocols. Taking one example, in the current MiCA regime, the way it's being worked out, they might ban self-hosted wallets. If you ban self-hosted wallets, you're essentially killing all type of DeFi innovation, so people will just do it elsewhere. So that's the type of stuff we monitor at Applo, and it's uncertain at this stage. On the other end, we've been approached by a lot of fintechs and payment companies that are looking to plug in different parts of the DeFi ecosystem or crypto network, not to offer crypto trading or anything, but just as it would be one small rail of their entire infrastructure that will allow them to offer faster payments, or more security, or insurance, like some stuff that you wouldn't even think about. We don't think about it. They come to us with the ideas. And I think 5 years from now, you'll have a lot of these pretty hardcore fintechs that are embedded into crypto on the back end and offering better services that people won't even know it's because of crypto or DeFi.
Yeah, I see the same.
I still love the inclusiveness and openness of the blockchain technology, and I think that's what at the core drives the speed of innovation. And then where does the innovation go? We can look at traditional financial services. I think we more or less nailed the sending money around, and now we make the next step into programmable money. What can we do with programmable money? Can we program a bank? And if you deal with your bank, it's mostly money on one side and then something else on the other side, your house, your mortgage, your car, whatever. And I think there is still a huge step to be taken so we can put real assets onto the blockchain, and then I think the programmable money will do what we see from the banks at the moment. But that depends so much on the regulation, on the legal framework, and that's only getting more difficult in a way because blockchain is global, but the jurisdictions are local, so it might be a bit slower there.
Yeah, I mean, on the regulation front, I think it's almost a double-edged sword in a way, because the certainty that a regulatory framework will bring, I think, will really open the floodgates for significant institutional involvement. It's very difficult to get something past your risk committee when you work for a bank. If your counterparty is unregulated, it's a much easier conversation and a much easier process for them to be able to start participating. But I think you're right in that it has the absolute potential to stifle innovation too. There's the discussion around self-hosted wallets. There's the fact that stablecoins are going to be regulated as e-money, which means you'll require an e-money license to be able to hold them. I think there's a lot of challenges there, and MiCA won't be perfect. So I think it will be a double-edged sword, where there's even some kind of other things outside of MiCA, like the travel rule and the whole thing about having to understand the identity of the wallet address that you're sending to. So I do think, though, and we talked about this earlier, I do think as an industry, we need to be better at when we engage with policymakers, not just regulators, but I think policymakers are the people who will be writing the laws that the regulators will enforce. We need to be better at describing what we're doing and describing it in a way that really makes sense to them and is proportionate. And so, for example, staking and yield generation, is it a utility function? Is it yield generation? We need to be careful about that, making sure that they understand that we're participating in the network and getting a reward for helping the network run, and that it should be regulated like that and not necessarily in a different way.
I'll just clarify my previous words. We're definitely pro-regulation at Applo. It's just, as you said, it's a question of where you put the cursor here.
I think we can open up to audience questions. Oh, Max. So to repeat the question for the recording, in the old world, there were things called banks that you took deposits and provided interest on these interest rates. In this new world, protocols, others, there's many ways to generate yield, as we've discussed. What are your arguments, or what's your view, and that when you're discussing with regulators, for example, on why these applications do not require the banking license that was previously required in providing interest on deposits, for example? Does anyone want to take a stab at that?
I'll give it a go, not from a block demon perspective, but from my previous life as a lawyer. I think you look at two things. You look at the characteristic of the token itself, and then you look at the characterization of the activity. So I think banks get regulated because their equivalent of the token, the money, is a regulated instrument, and then their activity is regulated because they're taking that on behalf of someone else, and the risk that you're trying to mitigate is that they have your money and they could do something wrong with it. So I think whenever you're talking to a regulator, when you're talking about your activities, you want to look at both the characterization of the actual tech, like is it a utility token? Is it something that will be regulated as e-money, or is it a security even? Because this is just a technology. It can be used in many different ways. Then you've also got to look at your activities. So I'm not sure how you guys talk to regulators about it, but that's how I would approach it.
So in France, there's a pretty old Napoleonic law that states that if you lend out a few bushels of wheat to someone, you can expect to get those bushels of wheat back and a bit of wheat an extra. And the whole purpose of that was for people to be able to lend and borrow commodities between each other, especially food and things like that. And how that translates today in the French crypto framework, because there is a crypto regulatory framework, is that crypto is a separate asset class. It's not cash, it's not securities. And so it falls under that civil law framework and not banking law. So when you use the yield product on Applo, it falls under civil law. It's a civil loan between you and Applo. And so we have a bunch of other regulatory frameworks that are pretty heavy to follow, but for that specific one, it's not banking law.
Crypto, wheat of the future.
It's wheat. There you go.
I think it's a great revenue source for lawyers. So we as business, we have actually a significant budget allocated for lawyers to find an answer to this question. And unfortunately, still financial market operates globally, but regulated locally. So we have spent a lot of efforts in every single country. So even if we speak about rewards, crypto rewards that we provide to our customers from our platform, we're unable to pay it in Switzerland, for example. So we're still in the process of finding the best answer for Switzerland. So it's available on the country-by-country basis because, again, regulation is still different and we still need to pay much more to lawyers.
Yes. So the question was to provide concrete examples of what type of, or what percentage of yield you can expect and from what? Did I get that? Yeah. And the risk. Okay.
And the price prediction for Bitcoin in 3 months as well.
It was throwing it over to you.
That's for you.
Oh, that's for me. Okay.
This will vary across, I'm sure, but I think some of them we touched on in terms of the risk management, but.
Yes, I would say they're around that 5% give and take, so like several percentage points compared to classical finance, centralized finance. And the risks, they are really manifold. You depend on this whole ecosystem of blockchain, the protocols, the operation, and in staking, the slashing risk as well. So you really have to dig into the details. But I would say it's very attractive, even if you're not interested in the details of the technology and just come from an investor point of view. It is a very attractive yield.
Any other examples?
I mean, I can give one. Last time I looked on our platform, I think you could get around 15 or 16% on Kusama, which is one specific coin. It's not super liquid, so great, you're getting 16% on Kusama, but now the biggest risk is price slippage. Because if you want to get dollars, you're going to have to exit that Kusama position, and you're definitely not getting your 17% back if it's a sizable position. So that's the way you have to look at it every time.
Maybe just two more points. When we speak about interest rates and risks, we should not forget about two other parameters. Lock period, if we speak about staking, we should keep it in mind. And second, limits. So with some platforms, you can earn like up to 15%, but with a strong limit like up to 10K, for example, in dollar equivalent. So two more parameters. But in terms of general numbers, I would agree with Michael, I think.
Yeah, and I think the lockup period is something that we didn't mention before, and that will also vary between the different platforms.
An interesting metric to look at there. Same thing, the data point is from a few weeks ago, so bear that in mind. But I think the total value locked in lending across crypto was a bit above $50 billion. So if you're an institution and you're thinking about a yield generation strategy with crypto loans, keep in mind that very basic law of trading, which is if you're starting to move more than 5% of whatever market is you're moving, you're going to have trouble. So just also something to bear in mind.
Yep.
So it's interesting that when you look at regulation for crypto, with regulation with banking as a success. When we look at long-term capital management, dot-com boom, 2008, which Bitcoin pretty much so became because of the failure of the banking system and regulation. Saying we're starting to apply that regulation here. So I would really value your opinion. Do you see the blockchain, the future of it, as complementary to the current banking system or as a viable alternative?
Okay, so repeating the question again for the recording, we've been comparing here regulation of the crypto sector to regulation of the banking sector, and obviously, first instance of a crypto, Bitcoin emerged out of the global financial crisis. What do we see as what's the goal here? Is it to become like the banking regulation, or how do those two worlds combine, and what would be the best outcome?
I think it can be both. I don't think it's an either or. I think in some ways it will be very complementary, and in other ways it might actually be a better alternative. I personally think that what we're seeing at the moment is this might be a controversial statement, but I think what we're seeing is a large influx of people from traditional finance into the crypto space. And a lot of the innovations that I'm seeing at the moment really look like stuff that's happening in the traditional finance world, but just using a different technology, even just or different terminology. And I think that's normal because when people first encounter something new, you're going to contextualize it, you're going to compare it to what you know, you're going to use your own knowledge. I think what we're going to see in the future, as more of this knowledge comes into the space and as they become more familiar with the technology, that's when we'll start to see true innovation. So I don't necessarily think the activities that we're seeing today are what is going to exist in 10 or 15 years. I think we will continue to grow and develop, but it doesn't need to be binary, does it need to be either the banking system or crypto. I think we can be both complementary and also offer better alternatives in many different ways.
But maybe to expand on that question too, then, do we run the risk of kind of pigeonholing crypto into existing banking regulation and ending up with the same system that we had before, with maybe sort of updated rails? Or how do we prevent that if that's not the future that we're hoping for? But again, just expanding on the original question.
Again, just my opinion, but the smart way to look at it is banks have a very specific role, which is accumulating capital and deploying that capital in markets and offering smart services around that. And in the past 50 years, they've added a new role, which is let's build out internal technology and create moats. But the only result of that was adding additional operational risk and making sure that no bank could really work together without two people validating an Excel file at the end of the day. And so if you look at crypto as just a common piece of infrastructure for all those banks to play on, and then you refocus the bank's role on accumulating capital and deploying it, well, you still need the banks. And you still need some form of regulation in terms of who does what with the money you're saving. But then instead of having all the regulation piled up on 6 banks and putting so much pressure on them, you could split it up and put a bit more on protocols, a bit less on banks, and make everybody accountable. And you don't have like insane pressure on 3 people that are, not sleeping every day. That's just my opinion.
Love the question. You're referencing LTCM and the subprime housing market. And I think what happened there is that the incentives to certain players were set to exploit the system or make it eventually unstable. So people wrapping up mortgages, getting high commissions, rating agencies giving it good rating, even though there was much more risk in there. So the sum of the incentives didn't add up to a stable system. And what happened with the Bitcoin white paper that followed shortly after was once, for the first time, a system that's trustless, where it's built around incentives that create a stable outcome. Some claim it's like the most anti-fragile system. We'll see, but it's and Bitcoin, I think, has these stable properties. So I can't expand on whether this will eventually get into a whole financial system that can compete with traditional banks. I think we leave that open to the competition and see what happens. But in essence, I think it does. It's shown one example where it is the solution to a problem we've seen multiple times, leading to crashes affecting the whole globe.
I think. Sorry, just one more thing on that. I think one of the things that we're seeing at the moment too, blockchain's an ecosystem technology. I think at the moment we have multiple different types of ecosystems, like we heard today about the use of NFTs in the metaverse and gaming and things like that. I think a lot of ecosystems that we're building are a little bit similar to what we're seeing in the traditional finance world. So we'll see an ecosystem of players, and there'll be a liquidity maker, and there'll be and I think where the real kind of innovation will come is when we start seeing the merging of all of these ecosystems. So we're not just talking about yield generation and using crypto in a kind of pseudo-financial sense, but when we're actually looking at a very broad ecosystem of different things that people are doing with the technology or even with the kind of tokens themselves. And that's where I think we're going to start to find it be really interesting as far as where we're kind of headed.
Maybe just a few words coming back to your original question. So I think it's complementary, but there is no black and white. So we can speak about evolution. So we in Switzerland we already have 2 fully regulated banks, crypto-native banks, SEBA and Signum. I guess in the next few years we'll have more examples when crypto companies will get traditional banking licenses just in order to cover their services. So on this, at the same time, we will have more traditional banks offering crypto-native services. So it's just an evolution. And in the morning, during the Cardano keynote. It was a great example about cloud-based services and prediction that, as it happened with cloud-based services, in a few years from now, we all will be blockchain-based in terms of data storage. The same happening with banks. So, like 10 years ago, not all banks offered internet banking service. Right now, they all must offer it, or they will not survive. So the same will happen with the crypto offerings, I guess. So it's just an evolution, I guess.
I mean, but banks are just a way that we store value and they help us move value. And so I think you're right, but I think also the role of storing and moving value, or how we do that, might change as we build out the ecosystem. So maybe the way that we think of the utility of banks will change the way we think of the utility of the technology and how we're moving it.
Question here?
Yeah, I have a very down-to-earth question. We're talking about yield. So currently, the net treasuries oscillate around 3%, trend up. The option adjusted spreads on US high yield is 100 basis points. So we're getting more into 8-9%. Where should the crypto and DeFi trade and offer as yield so that people start to switch from traditional, high yield bonds to crypto? It's getting easier.
Okay, so the question here is around traditional rates, or the differential between traditional rates and crypto rates is getting thinner. So why should people feel motivated to switch from traditional into crypto?
My point is that we should not switch between one and another one. We should use both. So it's the obvious answer. So, but obviously, interest rates on the crypto market will be higher. How much higher? We'll see. So it depends on the real efficiency.
Well, you saw Anchor. It was, if your question is how much more do you have to offer to switch people in, Anchor offered 20%. It brought a few more people in, and then it crashed. So I don't really know if this is the way we should be looking at it. I agree with Ilya. It's more about just spreading your risk, and you get 5-6% on USDT. That's already really good. That should be, maybe just stick to that.
Yeah, question.
I can fill in.
Oh, sorry. Go ahead.
I think you can take the opposite perspective and see, how do you design the protocols so it's attractive for classical investors to put some of their money into the network for this to be operational. So I hear these examples that Ethereum has the same PE ratio as Apple. I think that's no coincidence, and it's not a property of the network. It's a design criteria that you must make the network attractive enough compared to alternatives so it becomes viable.
So the question here is around CBDCs, and what's your take on that, and how it will interact with the crypto space, or what the implications might be of government-issued stablecoins?
We will utilize them the same way we utilize now Swiss francs, US dollars, euros. That's it.
Yep.
We
So
don't talk
that's
about that here.
That question was on where is the real, or what's your take on real value creation in the space versus crypto people borrowing and lending to each other?
Let's
leave me hanging on this question.
Let's disrupt the panel. Diana, what do you think about it?
What do you think, Diana?
Well, is that okay? So I think that there's definitely. Wait, am I supposed to answer this? No, you guys go ahead.
Stole my joke.
I can, but I think we're looking to the panel.
I mean, it's as for any type of highly explosive market, out of all the BS projects, you do have some gems, and that's the stuff that'll build the future. Same with the internet. It's you do need some crazy people that are just throwing money around without understanding much for things to move. But my opinion again.
Yeah, I kind of think that the real value is when you're actually using the technology to its fullest potential. And a lot of the stuff that we're seeing is can you use blockchain for it, and is it a good use case for blockchain? Sure, but is it the ultimate use case for it? I don't know. I think it's when you're solving problems, and whether it's looking at how do you distribute value amongst a complicated, interconnected ecosystem that doesn't actually have direct relationships. I think that's the kind of thing. If you look at what the technology is solving or able to solve for, I think that's where we'll start to see real value. So it's not. I think you're right. It's not just about crypto and trading and generating yield. It's about getting value across the full ecosystem. I actually think as well we have a bit of a challenge at the moment as an industry with data, which I think is hilarious given that blockchain's all about good data, but just using the data better and allowing us to see so for example, you might look at a protocol and see how much is staked in that protocol, and then you might judge the value of the protocol based on different measurements. But how do we make sure that as we have all of these different projects going on across the ecosystem, that we can make sure that the data is connected and that we can really start to see the real value? I think it's not easy from a technology perspective, but I do think it's something that we should work towards too, so that we can answer questions like these and we're not just talking about specific use cases.
Do you have a view?
Yeah, I mean, who would have thought to bet on an internet bookstore in the early 90s? So we don't know what the killer applications will be. We have the intuition that money itself on the blockchain is a killer application, but I'm sure it's not enough as a use case. It must have other utility, other real use cases. Always do the thought experiment: what happens to society if blockchain goes away from one day to another? At the moment, probably nothing that much would happen other than to a few of us. But yes, we need more real utility coming out of it, I agree.
But I think if we take a step back to what the panel alluded to earlier, what we're doing here is we're re-architecting the infrastructure for financial services, where we will see this interoperability between traditional finance and these new protocols and decentralized infrastructure that we're building in order to create a more transparent, a more efficient, global, interoperable financial system and beyond financial system into all of our digital lives with Web3 as well, and one that breaks away from the existing silos that we're trapped in today, as well as the legacy infrastructure. And with that, we're at the end of our panel. So I'd like to thank all of our panelists for their insights, and thank you all for joining us today.
Thank you.